India has just offered foreign investors a deal that most countries rarely do. No tax on interest income, no tax on capital gains, and it's all aimed at one asset class, government bonds. At first glance, that sounds like a tax story, but it isn't. It's actually a story about how India is trying to attract more global capital, lower borrowing costs, and cement its place in global financial markets. So why is India making government bonds more attractive to foreign investors? Let's understand. First, what is a government bond? Think of a government bond as an IOU. When you buy one, you are lending money to the government. In return, the government pays you interest and promises to return your money when the bond matures. Because these bonds are backed by the sovereign, they are considered among the safest financial assets in India. And they are important. The yield on the benchmark 10-year government bond influences borrowing costs across the economy, from corporate loans to home loans and business financing. So why does India want foreign investors? The answer is simple. India borrows a lot. And when more investors buy government bonds, demand rises and yields tend to fall. Lower yields mean the government can borrow more cheaply. And that can eventually reduce borrowing costs across the broader economy. For years, however, foreign participation in India's bond market remained relatively low compared with several other emerging markets. That's because India maintained investment restrictions and tax hurdles that made access more difficult. That began changing in 2020. The RBI introduced the Fully Accessible Route or FAR, allowing foreign investors to buy designated government bonds without investment limits. That reform opened the door. Since then, Indian government bonds have been included in major global bond benchmarks tracked by international investors, because many global funds simply follow these indices. When a country's bonds enter an index, those funds automatically buy them. That creates a steady source of foreign capital. And that's where the latest tax exemption comes in. On June 5, the government exempted eligible foreign investors from both withholding tax and capital gains tax on government securities. In effect, India has made its government bonds even more attractive to global investors. The timing is important. The rupee has come under pressure this year. Foreign investors have withdrawn substantial sums from Indian equities, and policymakers are looking to broaden and stabilize the country's investor base. This isn't just about attracting a few more investors. It's about making Indian government bonds a core part of global portfolios. The larger the foreign investor base, the deeper and more liquid the bond market becomes. And the easier it is for India to finance its growth. Which is why this tax break is about far more than just taxes. It's the latest step in India's long effort to make sure global capital sees Indian government bonds not as a niche investment but as a market too important to ignore. Follow Business Standard for more such stories.